As we close 2020, the puzzle between roaring markets and a struggling economy stares us in the face. Can markets continue to hit new highs even as the economy is only slowly healing, and many economists are doubting if it will return to its pre-COVID pace of GDP growth even by FY23? To better understand the macro and the markets, I have someone who is good at both. I am joined by Neelkant Mishra, the Managing Director and India and I think Asia Pac equity strategist for Credit Suisse in our ongoing series Outlook 2021. Neelkant, I can't tell you how important you are to this series because, as I say, I've done a couple of market masters and economists in this series, and the views are somewhat divergent, with markets being very cheerful or market masters being very cheerful and economists being a little doubtful. So I want to start with that. What is your assessment? You seem to indicate that you are expecting that the Indian economy will grow well over 6% by the time we come to FY23. Why do you think so?
See, the first thing is that the pandemic damage to the economy was in order to prevent more deaths and allow the economy to prepare for the pandemic, we locked down the economy. Now, the main reason why we saw a 24% decline in June quarter GDP was that the activities were restricted. So if you remove the restrictions, then of course the economy bounces right back. Now, the secular growth in the economy in the last 30 years has been about 6.5 to 7%.
Yes.
Even if you assume that in the years running up to the pandemic, we had slowed down. So if you take 6%, in FY22, we would have been 12 to 13% higher. That was what the consensus GDP growth forecast was, FY22 over FY20, before we went into the pandemic. Now we are at about, as you say, plus 1%. Now, if you assume that for 6 months the economy didn't grow, right? So just get it off the clock. What you get is, so you remove 1/4 of that, so 6 months out of 24.
Yes.
Then you should still be at plus 9.
Okay.
But then there is a problem, right? So there is a problem that there will be scarring, right? So the lockdown and the losses of GDP in the last 6 months will clearly have some impact on potential GDP, people's willingness to spend, people's ability to invest and all that. You take some off, but are you going to take off 8%?
Okay.
And I think that as the numbers are getting revised, so for example, if you go from 100 to 76, go back from 76 to 100, because see, the 100 to 76 happened because you restricted activity. You need 33% growth.
Yeah.
So the numbers that people have used, and I think those themselves, because these are such large moves, I don't blame them. I think the numbers are perhaps underestimated. And what is also important is that many of the headwinds to growth that we had seen, like, even March quarter itself, even the month of March itself was disrupted by the pandemic. In fact, when I look at the inflation, the fiscal numbers that I see, people forget that in the month of March, or at least in FY20, the fiscal deficit came out to be 1,60,70,000 crores more than what was revised estimate, and all of it happened because of a drop in receipts.
Okay.
Because the government allowed people, and so all of those taxes were due, right? It's not that they had to be generated in the last 10 days. So as that tax payment happens, and it is now starting to happen, you may have seen that in October, personal income tax collection was up 17% year on year. So I think the fact that the March quarter itself was disrupted, GDP growth was 3.1%, and last 15 days we saw very little activity, is something that needs to be incorporated when we are thinking of these numbers. And therefore, I think the sharp disruption has also kind of unhinged the ability to forecast. And therefore, I think there can be upgrades to FY22 numbers and also therefore FY23.
Okay. Well, Neelkant, I want to be proved wrong, but my skepticism is that, as you say, there can be large parts of the industry which can be of demand, which can be permanently scarred. And you also point out that the government is the PLI schemes, putting money behind the winning horses should also give a lot of points to GDP. Now, I will come to that in a bit when we discuss markets. But my point is, manufacturing is per se not a growth generator. So even if it is an output generator, it is not a growth generator. See, from 70 to 90, 1970 to 1990, we got a big fillip because we had agriculture as the engine of growth, the Green Revolution and what followed. After 91, we had a huge services growth, IT, which again is people-oriented. PLI is not people-oriented. So even if it gives output, will there be, it may not create so many jobs is what I meant. When I say it's not people, it's not labor intensive. So is there a problem of demand?
Okay, so let's first think about the problem of demand, right? So, it's important to remember that the top 10% in India consume more than the bottom 50%. I'm not talking about incomes, I'm not talking about savings, I'm talking about consumption, demand. And as we had highlighted in our Beyond the Pandemic analysis, so if you remember in early September, we came out and said the economy and the virus are getting delinked. People thought we were nuts because, there were 100,000 new cases and 1,200 new deaths. And we were saying, oh, there's not going to be a link. And we were lucky it did turn out that way, thankfully. The fact is that in that analysis, we also said that the higher income households are coming out of the pandemic with better balance sheets than earlier. And this has happened globally. It's not just in India. That you've seen financial savings shoot up, right? And that's because the higher income households, their consumption was more affected than their income. For the low income households, the consumption cannot be cut, right? And their income was affected. And therefore, their balance sheets are much worse, right? So they have taken on more informal debt or they have had to shed assets. Now, when you get out of this, the lower income households, the only thing they can curtail is their own discretionary demand.
Yes.
They're then the worst affected. But that's very little. Their total consumption is mostly non-discretionary, right? And the upper income has actually come out all guns blazing, right? Which is why you have seen demand for cars and high-end refrigerators and TVs and all of that has come out very well. So the impact of the economy. So I think this is something that the weakness of the informal sector, the weakness of the poor is something that policy needs to address. But in terms of the total economic impact of their weak balance sheets, the impact is not that. The PLI job creation, the handset scheme, the target of the government, or at least the estimate of the government of direct job creation is about 300,000 jobs, right? Now, the indirect job creation, which I assume means upstream investments, right? So basically that when you're doing a handed assembly, the objective is that over a period of time, you will get the upstream industry to come in as well. That's 900,000 jobs. In textiles and apparel, basically I think the apparel PLI is going to focus on man-made fiber. Is expected. I mean, the funds have been, what budget has been given, what the scheme structure is, we will get to know. Every $1 billion, this is what industries tell us, that every $1 billion is like 150,000 jobs. So that itself can create a lot of jobs. But see, we have to remember that if you are thinking of value add, so suppose in autos, right? So you can say that a large amount of funds in autos, how many jobs does autos create? But it's not just the final assembly folks, right? Because it's not the OEM.
It's the ecosystem.
It's the upstream value, right? And the very fact, and this is again, so the remarkable thing about PLIs is not, I think what you highlighted was very important, that the government is incentivizing growth by companies by giving them monetary incentives. But also they're relying on champions. So they're saying that the incentive size has to be large enough so that large firms can grow. And there is a third principle, which I think is even more fascinating, is that they have figured out that if you encourage downstream investment, like say handset assembly, the cost of assembly in handsets, test and assembly is like 3 to 4%. In mid-end phones, maybe 8, 10, 12%. But the incentive of 4 to 6% is actually a very large part of the assembly cost. So that encourages the assemblers to come to India or increase India's production share. It triggers then the upstream investment. So So in autos also, if suppose the car exports from India go up a lot, there will be a lot of investment and job creation in the component supply chain.
Okay. Okay.
So I do think that there will be income generation
Okay.
in India.
So there is a growth multiplier that you are expecting. Now, very quickly, I have to take my first break, but I want one number from you. If the world is telling me that, or many economists are telling me, not the world, that we will be only, 1% or 1.5% higher than March 20 in 2 years, what is your number?
No, I think we will be at least 4% higher, right? So, so there should be at least a 3% upgrade to what consensus is at.
Okay.
And I'll tell you why. Right? Over and above what I just said, that it's just an accounting and arithmetic problem, which people are struggling to give us such a high number. It is also that if you think about the PLI schemes that start in FY23, the FY23 PLI schemes will require that the investments are done in FY22.
Yes.
So the moment the firms are identified, they are going to be in a hurry to do capex. If you may not have noticed that in the handset scheme, because the revenue targets are from 1st of April 2021, companies have been using air freight to ship equipment from China to India. They're in such hurry to capex. As that happens, you're bound to see some growth acceleration.
Okay. I'm going to hurry you because I want to ask you about markets now. I take your point, Neelkant has also argued that gross fixed capital formation already has not done too badly in the second quarter. So from your argument, GFCF will do very well in the subsequent years. As well, government expenditure is going to increase in the second half. We don't have time to discuss that. So that will be the tailwind for growth. Now, what about markets? The markets, as Neelkant's report says, is already priced to a 21% earnings growth in FY22. Okay, so all that is in the price. What next is what I'm going to ask Neelkant after this very short break.